In 1988, Warren Buffett bought $1.3 billion worth of Coca-Cola stock, and it's now worth over $25 billion. He didn't guess. He calculated, and his secret weapon? The DCF model. Here's how it works, made simple. DCF stands for discounted cash flow. It's a method investors use to figure out what something is really worth, not based on hype or stock price, but on how much cash it'll make in the future.
Wow.
The idea is simple. $1 today is worth more than $1 tomorrow. So the DCF takes all the money a company is expected to earn in the future, adjusts it for time and risk, and tells you what it's worth today. We'll break it into 4 easy-to-understand steps. Estimate the cash the business will produce in the future. Decide how fast those cash payments will grow. Choose a discount rate that reflects how risky this cash is. Add it all up, including what the business is worth after your short forecast, and you've got a value. Step 1. Owner earnings, the cash that truly belongs to you. Buffett doesn't just look at profit on paper, he looks at real cash. He calls it owner earnings, which basically means the money the business makes after paying for everything it needs to keep running. In simple terms, owner earnings equals real cash coming in minus cash needed to maintain the business. It's like owning a shop. Your owner earnings aren't the total sales, but what's left over after restocking supplies and keeping the lights on. That's the money that actually belongs to you, and that's what Buffett uses in his DCF. Step 2. Forecast a few years of cash flows. Don't pretend to see forever. Buffett often says, don't forecast 100 years of tiny guesses. Forecast what you reasonably can, maybe 5 to 10 years, then handle the future beyond that with a sensible terminal value. Here's a tiny example, so the idea is concrete. Imagine a company with free cash flow next year of $100. You think it will grow 5% a year for 5 years. After that, the company settles into a steady, slower growth of 3% forever. Let's make those numbers clear. Year 1, free cash flow is $100, and the next 4 years are as follows. Those are the cash amounts the company is expected to hand you each year if your forecast is right. Step 3. Discount those future cash flows to today. Future money is worth less than money today. Why? Because you could have invested that money somewhere else. Inflation erodes it, and there's a risk the cash won't arrive. We capture this with a discount rate. For our example, we'll use 10%. Think of this as the return you want to earn to justify the risk. Let's discount each year's cash flow with this formula. Year 1, $100 discounted 1 year at 10% gives $90.91. And the next 4 years are as follows. If you add those 5 present values together, the total is about $415.06. That's the present value of the predictable cash the business will hand you over the next 5 years. Step 4. Add the terminal value, the business after year 5. Most businesses don't stop after 5 years. We assume the company continues to generate cash forever, but at a steady, lower growth rate. Our terminal growth. In the Buffett world, this is the part where you must be conservative, because small changes in assumptions make a big difference. In the example, assume terminal growth to be 3%. To get the terminal value at the end of year 5, we do this. First, estimate year 6 cash flow. Year 5 cash times 1.03 gives $125.20. Using this formula, we can find the terminal value. That number, $1,788.53, is the value at the end of year 5 of all cash the business will produce after year 5, assuming our steady growth forever. We discount that back to today, 5 years at 10%. We will have $1,110.54. Now add that to the $415.06 we already calculated for years 1 to 5, and the total present value, the DCF valuation, is around $1,525.60. So, if you believed every assumption in this simple model, you'd say the business is worth roughly $1,525.60 today. Quick note about the arithmetic and sensitivity. Small changes matter. If the discount rate goes up from 10% to 11%, the present values fall noticeably. If terminal growth changes from 3% to 2%, the terminal value shrinks a lot. This is why Buffett stresses margin of safety. Buy at a price well below your conservative estimate of value so that small mistakes in assumptions won't blow you up. Always run the DCF with different scenarios: a base case, a bear case, and a bull case. If even the bear case gives you a margin of safety relative to the market price, then you're comfortable buying. Practical step-by-step to run your first simple DCF. If you want to try one yourself quickly, Step 1. Estimate owner earnings for the next 12 months. If you're unsure how to adjust for maintenance costs or working capital, use the company's reported free cash flow as a practical substitute. Step 2. Forecast 5 years of those cash flows with a reasonable growth rate. Be conservative. Step 3. Choose a discount rate, often something like your required rate of return, 8 to 12% for many investors. Step 4. Pick a terminal growth, 2 to 3% for mature companies, never higher than long-term GDP growth. Step 5. Discount each year's cash flow and the terminal value to today, then some. Step 6. Run conservative and aggressive scenarios to form a range. And lastly, Step 7. Compare the resulting valuation per share to the market price per share. If there's a comfortable discount in the worst reasonable scenario, you might have a margin of safety. Buffett has said variations of this many times. Price is what you pay. Value is what you get. A DCF helps you estimate what you actually get, the stream of owner earnings, and to convert that into a price you would be willing to pay today. But he also says the best tool in investing is common sense. A DCF should confirm your common sense judgment about the business, not replace it. Use it to test whether the price makes sense for the cash you expect to receive, and always build in a margin of safety. If you found this helpful, hit subscribe and keep learning how the smartest investor in history thinks.